For more on the markets and their reaction to Friday's numbers, we want to bring in Cameron Dawson. She is Chief Investment Officer of NewEdge's Wealth. And what do you think, Cameron? Was this a Goldilocks number that means that the Fed is going to pause, but the economy is going to still have a soft landing?
I think it definitely was a Goldilocks reaction. I think that's the perfect name for it because it's really a market that could have it all. It could have an easier, more dovish Fed talking about a pause, but then it didn't have what usually would come with an easier and more dovish Fed, which would be a slowdown in growth that would hit earnings. And so that does explain why the reaction in the market on Friday was very different than what we've seen in recent months, which was really just led by tech names and really a flight to safety. Instead, Friday was much more broad. It was including names like cyclicals, and we had much better performance out of the Dow, for example, than we saw out of the NASDAQ. And so that does reflect this optimism that growth is going to hold in better than expected. But then we'd ask the question that if you have better growth, really, would you get a more dovish Fed? And we don't think the answer is yes, just because inflation is remaining sticky, which means that there is still upward pressure on interest rates likely to be had.
You think the Fed is going to pause at this next meeting or no?
I think they will just because they've messaged it so much, but it might not be the biggest story coming out of the meeting. We'll get an update to the summary economic projections, which will likely include them raising their growth forecast, even though they might be pausing, and maybe lowering their unemployment forecast. They have a 4.5% unemployment rate marked down for 23. That likely is too high, even though we had that slight tick up on Friday. We'll also get an update to the dot plot, which will likely show more raises and less cuts in 23. And so it's likely that the messaging coming out of the meeting might be more hawkish than the actual decision itself to pause, and that we do think if they pause in June, a July hike would be very, very likely.
Okay, so a pause is really just a pause and not a reset.
Exactly.
Which means what in terms of where we are with the markets? I mean, you're talking about a huge run with the S&P now up almost 20% from the lows that we had seen back in October. Is this something you'd buy into at this point or not?
Well, we think that the onus for upside in the markets from here really has to come from the earnings line, because to your point, when you have a tighter Fed and you have tighter liquidity, which is likely going to come as well now that we're on the other side of the debt ceiling debate, it means that when you look at valuations today, we're trading at 18.7 times. That's the high end of prior ranges of valuations. And we don't think you can press much higher from there. So then really you would have to count on earnings coming in much better than expected. And there it's more of a question of, is every company NVIDIA? We don't really think that every company is going to see the big boost from AI in the very, very near term, like you're seeing with some of these semi names. And so we would look at earnings expectations today, say that they're already pretty optimistic. You have 10% growth marked down for 2024, which would lead us all to the conclusion that likely some patience here is warranted and a digestion of the recent gains, just given that we've moved so far so fast.
Okay.
You're missing it. You're missing the rally, Cameron.
What would change your mind, Cameron?
You're missing the rally. Missed about 20% of it.
We've been invested. And I think that's the key point here, is that it's not as if we're sitting in cash and clipping 5% coupons. Where we've missed the rally and where we've been the most surprised is in those growth and technology stocks and really reaching towards the highest multiple parts of the market, because that's the area of the market that typically has been more sensitive to interest rates. And so we have seen interest rates move up as growth has been better than expected. However, we haven't seen that downward pressure on valuations. There's been a very clear divergence this year. And so when we look at this market in the very near term, the technicals are strong. We see good momentum. We do see within the growth and technology parts of the market very strong trends. But when we look in the medium term, we have to remain valuation disciplined. And so we're not going to chase names just because of strong momentum in the near term and completely ignore valuation, mostly because we are long-term and quality investors.